Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, April 17th, 2023. What I'll do in this video is a brief update on the equity markets. Definitely some levels to watch. We're coming up on key support on the S&P 500, and we'll get to NASDAQ here in a second. Then I'm going to do updates on some of the other recently highlighted trade ideas. That includes Treasury bonds, gold, silver, GDX, Bitcoin, Ethereum. Those are all on the short side, and then longs, I'll just do updates on some of the recently highlighted longs, let you know the levels to watch there. That'll be natural gas, lumber, various ag commodities. Speak a little bit to the inflation trade, and then just a quick update I wanted to do on time permitting municipal bonds, California in particular. Alrighty, that's a lot, but I'm going to just rifle through these quick. Not much to add on the equity markets. For the last, week or more, we've been bouncing around in this sideways trading range. I slightly tweaked my lower line. I had a support resistance zone here, but I wanted to set an alert, so I pulled that line down. I had it at, what was it, 12, right around 13,000. On NQ, and I have it at right here at 12,955 with an alert set because he had a couple nice clean reaction lows there, brief dip below it there, but that seems to really be the level to watch in my opinion. So that's it. And let's not read too much into it. Trading range is just that, bounce around. Only a definitive break to the upside or downside matters, not just little punches through the top or bottom that just reverse back in. And you guys know where I stand. Nothing has changed in my outlook. I still favor a downside break and more than just a little pullback trade. But again, I will give you the key levels that I think will come into play, important support levels, and if you're bullish, those are levels you might use to add to your longs or re-enter long trades. And if you're bearish, those are levels you might wait to see those levels get taken out with conviction in order to add to short positions. So that's NQ, NASDAQ 100. Bouncing around, going nowhere, frustrating bulls and bears alike. I give it to the bulls because they're, the market refuses to go down despite the divergences so far. So yeah, I'll acknowledge that. That gets a little check mark, but it's not a buy signal. It's just it's market stopped going up. You can look at a glass half empty as that market has run out of buyers and can't go up anymore, or you can look at it glass half full, saying that the bulls are in control, pullbacks are being bought, working off these divergences and overbought conditions in time. The correcting and the prices are correcting in time more than in value or price levels. So again, take it the way you want it, but let's just see which way that breaks, right? And then we'll go from there. I already gave you my thoughts. ES, the S&P 500. I colored that line up yellow. That's that uptrend line that I've been saying would give us the next sell signal in conjunction with NQ. You have to see the NASDAQ break as well. And there's a nice clean bearish rising wedge complete with your negative divergences there. This is also a 60-minute chart if I didn't make mention. That's what we're looking at on NQ. So right there, probably get a little hiccup there around 41.17 or so. But that'd be a nice sell signal. And again, we're going to need to see the NASDAQ breakdown as well, and that's probably going to coincide with a break of 41.17. So let's just say, for example, this wedge breaks down this week, right? What you'd probably see is run down there, hit that level, kick maybe a buyer step in one last time because it's pretty decent support, and at that very same time you would most likely see the NASDAQ also fall to that key level there. Now, let me just say this. All right, so this is important. The NASDAQ has already tested that level on multiple occasions. So there is a greatly increased chance that any reaction off that level will be fleeting or possibly no reaction at all, because we've already checked it. The buyers have already stepped in as expected. Remember back then on that first one, and each time you tap it, it increases the odds you're finally going to break it. So there it is. In other words, translation, if we fall back to that level again, probably not worth trying to game a bounce. Game a bounce on the first pullback to support, not the fourth or fifth, because at that point it's like tapping on something, hammering it, and eventually it's going to break. And likewise, bulls want to see that. You get that, pop these recent highs, pop out of the trading range, pop that high. That could send us up there again. I don't see it. I see the best looking bearish setup I've seen in a long time with those divergences on the daily chart. Trend indicators in the weekly is still bearish until and unless that starts to change. Any breakout to a high will probably only be a marginal new high that fails, extending the divergence. So I just wanted to say right now, it wouldn't change my intermediate. It might change my very near-term outlook if we pop that high, but it's going to take a little bit more than just a marginal new high to change the longer-term technicals on the daily and weekly charts. All right, so you guys know the levels to watch. Let's watch those. Let's move on to Treasury bonds. So as I said last week or the week before, I started, put on treasuries as a short trade for both a pure play because of the charts first and foremost. I would never take a trade. I cited this one as both a short based on the technicals, also a hedge to index shorts. Because as long as the stock market continues to go up or holds up, then you will most likely see this flight to safety bid undone. You don't typically, lately we've seen somewhat of a return to the flight to safety bid and the whole thing where treasuries go up when stocks go down and vice versa. So it was also a play on that, and it's worked well. So again, I wanted to reiterate that the Nasdaq 100 has gone nowhere but down over the last few weeks, right? So it's been peaked back on March 31st, and today is April 17th. So over 2 weeks of sideways to slightly lower action. So again, it's not like the market's running away. So that actually is one of those cases where this trade's flat over the last few weeks, and then the Treasury bond trade is playing out. So there's, let me just give you an update there. So we hit that first target, 131, 144 last week. A slight little flagging type action on it. The typical reaction, this is a 2-hour candlestick chart, so you're looking at 6 months of price history, and certainly a reaction, but that's a pretty weak and muted reaction. That's you got the impulsive leg down right there, a little flagging type action, and then you took it out today, so that's your next sell signal. Its support really is more of a zone, if you wanted. You could say from about here, right about there, down to there, but I'll still, that's still the next preferred target right there, just above that 129 support level. And of course, you zoom back out, it wasn't just a short at big resistance, it was also the divergent high right there, and then you went on to break the uptrend line, give you that wedge. And so that's it. So either way, Treasury's coming up to support. Let me just be very clear right now. The risk return is no longer favorable for a new short position. If anything, you should be looking to get ready to take profits anywhere, or lower stops to protect profits anywhere from about here where we're at now, a little bit of minor support down to that 129 level. Probably get a reaction there. And we'll see where we go. As of now, I'm leaning towards another leg down all the way to 127, but let's see where we're at. I think that's most likely going to be the case. All I know is that I'm looking out kind of near term on this right now, and looking for a run down to that 129 with a bounce likely. All right, let me give you ZN. You have a little less interest rate risk on the 10-year. This is the 30-year bond. And of course, you could be trading TLT. It would take me forever to go through all the charts right now. I'm showing you what I tend to trade. ZN 10-year, I'm going to give you a level right there. See, you can see we're coming up. You have a little bit of minor support comes in below, but that's that comparable level. So this is where Treasuries, the 10-year is likely to bounce. So just like ZB, you got a little bit of downside to the next support level. But remember, we're coming off a big high. I wouldn't get too cute trying to game a bounce off this level, because we just put in pretty powerful highs. This is only a 3-month chart with hourly candles, but the same thing. Divergent high 1, correction 1. second and even larger divergence. It's the same divergence, it just grew larger, and so therefore, but that logic, bigger divergence typically, not always, but typically leads to a bigger drop. So this drop now is equal to the previous drop, but yet you have a bigger divergent high. So you can go out to a 6-month chart and see it a little better. There it is. You can see big divergence. Let me just draw it in there. Boom, 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 DH1. So we've been diverging since that point right there, and yeah, we could certainly see some more downside. However, if the S&P 500 breaks down, like I started the video with, we're getting close to that uptrend line support, and then especially if the NASDAQ follows suit, then you may get a flight to safety bid in Treasury. So at that point, it might be prudent to book some profits or remove those if you took them as hedges. And there's that uptrend line right there again on SPY or ES. All right, next up would be, let's do the risk on stuff first, and then we'll get to gold, and that would be the cryptos. I gave it to you as this one I threw out. I didn't use the futures. Of course, you could trade the futures if that's what you trade, but I give you GBTC. This is the on the 60-minute chart. It was an official trade put out last week. Right there, 60-minute bearish rising wedge divergent high breakdown. It's up. The short trade is up about 5.25% today. That's how much GBTC is down, and we're coming up on the first target. We're getting there. You have that trend line drifted a bit. That's where it is right there. Wedge pattern, divergent high. T1 is at just above the 1605 support level, give or take. I tell you, you could probably move that line up to about right here, 1646, because you can see it's the top of those candles. But we'll just leave that target as is right now. And again, I think there's more. If I'm right on the stock market, though, this will most likely pan out to at least T2, which is down here, but about 14. Let me gotta move these. They always round this one off to the fourth decimal right there. So there it is, 1422 or so. That's GBTC, and that one's starting to move. More downside to come most likely. Then Ethereum, there's ETHE. ETHE, let's try that one more time. There it is. Down about 6%. And first target remains the uptrend line, and then did I not label? Oh, there they are. Okay, and then these levels here, you gotta pop it up and down. That's how you when they round them out to the fourth decimal like that on these, you just go up and down. And then it'll make it even. See, like right here, 8.0193. Edit, go. It's really 802 rounds off. So that kind of stuff. All right, let's look at the metals. Gold, GC, one of my best favorite setups last week when we had this nice bearish rising wedge breakdown. 60-minute, nope, 120-minute chart, 2-hour candlesticks. Breakdown, back test, break of the 2023 50-ish support as well, back tested that as well, and first target now hit 1995. Let's round that number off because it says 1994.99. Oh no, I can't. On this one, I can't do it. You can only move the line up and down, and it doesn't move in penny increments. So that's it. 1995 first target hit, but I believe more downside to come based on the scope of these divergences. That's just the early stages of what appears to be a trend line break or wedge break following the divergent high. Last time we had a divergent high was right there, and we also shorted that down in gold, and then we went long here and played, at least me personally, some but not all of the upside in it. Got out a bit early, but also overall on balance doing well in the metals and miners this year. And so that's that. I think more downside to come. 1963 next target, and then silver. Silver. Where are you? SI. Here we go. Also 2-hour candlesticks. Beautiful level. Big level right there, and we hit it. So remember last week we broke down, sell signal triggered. We had a nice down to the button, hit my first target, 25.25. Bounced as expected on the initial tag of support. and did also like gold, little flagging type action there, a little impulsive leg down, a little flagging, and then went on, took out the level today. There's a good example. Support, usually get a reaction on the initial tag, and then it broke, and now we're at the second target hit, 24,880, and that's good for, since just the breakdown right there, it's about a 4% drop in silver, and next sell signal to come on a break of pretty much today's lows, because that's that 24,888 support, and that's a big level too. That would be really big, and still what I favor based on the outlook for the euro. I'm not going to get too granular in this video. If I go over each and everything, we have one of those 45-minute videos. Don't want to do that today. I'm going to get back to finishing up on my taxes here in a minute. Right here you've got 24,880, big support. Remember, it was this high right here, cap, we got that down, we traded that, and then you had the divergent low. So it's wash, rinse, repeat. That was a divergent high here, and remember, gold went into a trading range just like the stock market's doing now. I'm sorry, silver did at the time, talked about it quite a bit, went into this trading range, even though we had the breakdown there in the back test, and I said, well, silver's not going to go anywhere until gold breaks down, and that's when gold broke down right there, and then silver broke down below its trading range and followed gold down. So that's what we need to see now. So remember, this would be a failure. That means this whole thing here would be a bull trap, and that's pretty bearish. That's going to send us down. I don't even have a target. I could certainly add one here in the midpoint. That's probably a minor reaction along there if you want to trade it, but I think if we break that, because of the nature of this pattern and the failed breakout and everything else, would probably come on down to at least that 23.47 right there on silver. And to be short the metals is to be short the miners, and that's GDX. Covered again, updated this as recently as Friday. Let's see if my lines will populate here. There we go. An old T4 from way back here, effectively hit to the button there, 3607, and we'll call it 36. And now the trend line is again covered on Friday. We had the sell signal, the break of the trend line, in that first support slash target right there, 34.17's hit. But if the metals go down more, which I think they will, you can see we're looking at a pending but not yet occurring bearish PPO crossover, what I call a high level bearish PPO crossover. The last two we had one right here and one right here, then all the way back here. So you can see I'm going to circle those. Those are the three most recent high level bearish PPO crossovers, and you can see what happened to GDX there. So in other words, yeah, we need to take that level out, but a minimum pullback target 33 right there. Let's see what's next. I'll talk on a little bit of longs here. We'll look at the natural gas. I got an update out to you today. Been covering that one in recent videos, and that is right here. Nat gas, NG. Here we go. So there's that big 2.244 level right there. Support broken. Then support, once broken, becomes resistance. As you can see, back tested it there. Rejected, and then boom, a breakout today. And that follows a divergent low. So that should open the door to at least these first next two targets, if not all the way up here. And that just fuels the inflation trade. Crude kind of started first. Remember, USO hit the key support, that 58.60 swing target from way back here last year, and has rallied up, but it's also at resistance. So yeah, definitely wouldn't be buying crude here. If anything, taking profits if you took it. In fact, maybe even some more downside, and that would most likely coincide with a drop in the stock market for implied or assumed demand destruction in crude. Also on this 60-minute chart, I'm jumping all over the place. This is CL. Let me move it down so you can see it a little better. CL, there you go. All right, CL just put in a nice big old divergent high on the 60-minute chart, has some support right here, which it's starting to crack right now. And I told you, I think back here, told you, that big run up. We had a little bit of divergence there. It got even bigger here, and I said we'd probably come back in and test this trend line. And now you have that trend line, that uptrend line I gave you back from a couple weeks ago when crude was up here. It also comes in with this downtrend line, which we gapped up above here, and we've been back testing. That's the downtrend line. You can see a lot of clean reactions back here. 1, 2, 3, 4, gapped up, and then been testing it perfectly. So that's almost like a magnet. There's your target right there. That, depending on if and when it gets there, you have the uptrend line as well. So that would be so I see a little more downside in crude. I don't know if it's worth chasing or not, but that's where I think it's going. And then remember, that's all part of the inflation trade. Everything, when I look at my commodities list right now today, as of the last week, everything's green. It's funny. I'm starting to see the the hindsight analysts come out, and I'm seeing headlines that the inflation war has been won. The Fed's been successful. Those are good timing indicators. Those folks that are coming out now and declaring it over or dead, because you're seeing, natural gas hasn't looked this bullish in a while. From this UNG setup. Anyways, we already covered that earlier. Up today, 6.73%. Palladium's ripping now, even though gold and silver are weak. Coffee continues to run. That was, last shorted. We shorted that here after being long, closed out our long, gamed it down to there. That's where posted was reversing right on that 49.48 when that target was hit, and it's just a resumption of a bull trend. And again, it's more of a resumption of the inflation trade. I'm going to show you a couple other things here. So platinum, what else is up today? You've got cocoa just continuing to run. So that's the story of that. DBA is the agricultural ETF. That just shows you right here. So this is food inflation right now coming up. After being declared dead. So again, it looks like a resumption of the bull market in commodities. And it's not just commodities. I've got a couple other charts for you. Housing as well. This is I just randomly picked two. I know the big markets. Miami, where I'm from originally. You can see, here's where market started cheerleading, thinking inflation was over. And what you've seen is a resurgence. So here's home prices. This is through March, by the way. So you're going to have a little bit of lag. But the inflation trade, despite, again, a lot of the folks coming out of the woodwork lately and declaring it over, my opinion was nothing goes up forever. So we had a correction in commodities and interest rates. Had surged, caused a little pullback at home prices, but you can see them at least through March, new highs. And that's we're looking at, by the way, the median sales price. So that's what I'm looking at. Houston, another hot market. Again, you had an abatement, rates started moving up, and the resumption there, and we're back towards, not far from it. So again, that's not all inclusive, and I always say, when we talk about inflation, the things that I can instantly quantify and tell you if inflation's running hot and try to get a good idea where the CPI is going to come in is the things that are traded like commodities, oil, gas, wheat, everything we just covered, the agricultural commodities, metals, industrial and precious metals, energy, that all is traded around the clock. Housing market, and that's a big part of it, and you can, yes, they use owner equivalent rents in the CPI. They don't use the median sales price, but that all goes in line. This is all home types. I didn't just do single family homes, and rents are going to be commensurate with home prices, obviously. And the value of houses and apartments are going up, the value of cost of rent is going to go up. So that's that. Anyways, just want to point that out. Inflation trade is still alive and well despite reports of its demise. I think that's to loosely quote Mark Twain. Oh, figure I'd give you a quick update on lumber. I was pointed out, that divergent low as looking bullish, as well as the long-term charts. We're looking at just a 2-hour, 120-minute candle, 6 month. We just hit that next target I gave you last week, 437. to the button there. So, yeah, getting a little stretched, but lumber often trades a lot like natural gas. It's either full throttle up or full throttle down. There are periods of consolidation. So, depending on your outlook, best thing to do is just raise stops, protect profits, or you can try to game the pullbacks. I don't have a strong opinion whether we're going to pull back here or not. I can tell you we're getting a little bit over. Well, a little bit. RSI is pushing probably 90. Yeah, it's safe to say we're a little bit overbought. So there's nothing wrong taking profits. We're up in just not even couple weeks, 17%. Oh no, more than that actually. That was before to the last update. Almost 20%. And again, this is what I'm doing. It's that whole vicious cycle, negative feedback loop. The market doesn't get the memo every time one commodity goes up in a single day or even a week. But if this trend persists, if you continue to see wheat, corn, soybeans, crude oil, natural gas, housing prices, the market's going to get the memo, and that memo is going to be that the Fed is going to be forced to remain hawkish, and the market's not going to like that. So anywho, just keep an eye on these. Yeah, I promised a short video, so we'll just wrap up here with one of many things I'm watching as the next potential shoes to drop. We already had a lot of things in the crypto arena blow up, and then of course the banks blew up. Both started with the regionals, and then one of the mega global banks, obviously Credit Suisse. And two of the other potential bombs I think to drop are private equity, and then we have an existing short on that. I'll get to that in a second. That's PSP, and then I think California as a whole. I think CalPERS, which the state of California and their taxpayers are on the hook for. We've known they've been running it, underfunded for years, and with these what I believe to be growth projections that are not going to prove to materialize, and therefore that's going to further increase their shortfall. And they've got to, they're on the hook to pay out those benefits. So, anyways, that's one of many. You're also seeing, industry flee from California. Tech, they're getting hit big. Anywho, I read an article recently, and it was about a week ago, and I can't cite the details, but they went from, again, I don't know the exact amount. It was a huge surplus, fiscal surplus, heading in for 2023, which all of a sudden now is a considerable deficit, meaning, yeah, everything they projected, and they're seeing a lot of, there's obviously the tech industry. You have all those layoffs. Tech was the first and hardest hit so far, and it's not like laying off UPS delivery people. These are high salary. The average salary is huge, and that's California has a lot of their revenue comes from taxing the wealthy. Pay almost all the keep the whole state funded for the most part, state income tax. So you have that shortfall now. With all those layoffs in the tech sector, you also have companies fleeing. Tesla was one of the first to move to Texas from California, and you're seeing that trend too. And then they said logistics is a big, big thing there. Across the board, you're seeing that. So I think this is a big one to watch. And this is California. California is still considered one of the world's largest economies. Bigger. The state of California's economy is bigger than most nations out there. I forget where it's ranked, number 6, something like that, against all other nations out there. So a big one to watch. And I'm the proxy I'm looking at, or look at their muni bonds. This is the one I've been watching. PCC, downtrend line. Recently had divergent low, but you rallied into that trend line, and you're certainly in the takeaway. You're in a downtrend, and smart money will watch this, and so keep an eye on these bonds. It's not a trade idea. I don't think I've ever shorted muni bonds, because when you short bonds, you're paying the interest, or in the case of an ETF, the dividends. But it's more of a proxy to watch for troubles that may be brewing there. So, and trust me, California's troubles will likely spill over to the rest of the country. So keep an eye on this one. And then PSP remains a swing trade. We shorted that one back here. believe it was, on the break of the uptrend line there, following the divergent high. Could have been in the rally into resistance there. Honestly, I don't remember where the initial entry or any add-ons. But either way, we went on down. We hit our first target. Hit our second target, almost to the third target bounce. And I just want to point out it is an objective short entry. We're at downtrend line resistance right now, and that 1030, which was the first target right there. And so very much still believe this one has a lot more downside to come. One of my fundamental reasons, right or wrong, and I don't read really anything about this. Maybe I'm sure others have talked about, written. What happened with the banks, what happened back in 2008, what's happened with the regional banks recently is the whole, what do they call it, mark to fantasy kind of thing, where you can cook the books, fancy accounting, and that's what the regionals were doing, marking their massive losses on Treasury bonds by marking those bonds to maturity, saying, well, there's no loss if you plan to hold at maturity, but there were. They're paper losses. Paper losses are realized when you go to sell. You don't always have the luxury to hold to maturity, and rarely do they. Bonds are trading vehicles. I don't think anybody or any institutions probably holds them to maturities. Maybe some long-term pension plans. But anyways, I digress. Point being, these guys are the same thing. Private equity gets to kind of mark their, because they're not publicly traded securities. They're buying. They're taking companies private. Companies that were publicly traded in many cases go private because then they don't have the onerous reporting requirements. And so they get to pretty much pick the values as to what their stuff is worth. And there's a lag time there. And as I've talked about before, when I dig deep, Harvard and some of these other big college that are massive endowments, or these things are huge. They've shifted a lot of their money into private equity in recent years, and have reported, even since the bear market started, some of them stellar outperformance, and in some cases even outright gains. I don't buy it. When we saw what we saw since the market topped back in the beginning of 2022, late 2021, it'll go down in history as one of the most painful broad-based sell-offs, where the whole 60-40 model broke because bonds were falling right in line with stocks. Crypto was going down, everything was going down, and so again, I don't buy it that private equity, they get to go ahead and value their assets at what they think it's worth. And so anyways, I think there'll be a day of reckoning. Now, the market goes up, that helps things. When everything's going up, everything's hunky-dory. I think it was Warren Buffett said, when the tide goes out, you see who's swimming naked. So if and when I'm correct on the stock market, we get another leg down that's going to take QQQ and the S&P 500 down to my next targets. On QQQ, we're still talking another 20 to maybe even 30% downside to those next targets. That's where more things in the financial system will break. Where are they going to break? I don't know. I'll give you a few things where I think that we might see it. We've already gotten, like I said, crypto, banks. It's a matter of, to me, what's next. And I feel strong that it's not over. That a lot of people are viewing the backstopping of the regional banks as that's it. Fed's back in town now. Not going to let anybody fail. Not going to let any financial crises happen. I'm not. I don't buy it. All right, I'm going to wrap it up here. Either way, trade what you want. I'll give you levels. I'll give you what I'm doing, what I'm watching, and right now that's what I'm looking for. Those next sell signals in the equity markets, and like I said, stay diversified. At least that's what I do. Different asset classes, different sectors. If you're trading mostly equities, spread it out. Don't put all your eggs in one basket. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.